Well, time's approaching 12:30, and here on Channel 4 it's time to go the rounds of Business Daily, presented today by Greg Wood.
The collapse of America's budget pact sends the financial markets into turmoil. Wall Street dealers brace themselves for sharp falls this afternoon. Peck meets with its bankers as fears grow about its future. Hello, welcome to Business Daily. Today, Peck and its bankers face a long haul as they wrestle with the company's debt crisis. Gateway supermarkets make the profits to pay the interest bills, but only just. As 15% interest rates celebrate their first birthday, we examine the prospects for mortgage payers. And limbering up for the recession, businessmen keep fit with the green goddess. But first, a look at the markets. The FT 100 share index is down over 30 points this morning, down 31.6 at 2038.8. The pound up by over a cent against the dollar at 191.85. The financial markets are bracing themselves for a crisis which, in economic terms, could rival that in the Gulf. The US Congress and administration now have very little time left in which to agree on measures to reduce the budget deficit. This follows the overnight vote by the House of Representatives to reject a budget-cutting agreement thrashed out by leaders of Congress and the administration over several weeks. Republicans opposed to tax increases and Democrats objecting to spending cuts combined to deliver an unexpected rebuff to President Bush. That could trigger automatic cuts in government spending and wholesale layoffs of federal staff. In a moment, we'll be looking at the likely impact on Wall Street and other financial markets. But first, Susana Antunes examines the prospects for a last-minute budget-cutting deal.
Congress has left itself with less than 17 hours to reach agreement on an alternative to President Bush's 5-year plan for cuts in the budget deficit. Failure will automatically trigger the sweeping terms of the Gramm-Rudman Act. That aims to balance the US budget by the end of 1993. If Congress doesn't agree on a package, the Act will at midnight tonight bring in cuts across the board, totaling $100 billion. That's equivalent to 8% of the entire American budget. But can Congress afford to let that happen?
Personally, no, I don't think it'll be allowed to happen in the sense that when the Gramm-Rudman bill was initiated, they did not realize that the kind of cuts necessary would be this draconian.
Even if the administration can put together an alternative in the remaining hours of today, commentators are skeptical that the package will stand up.
Frankly, I do not think that it will be entirely credible. For instance, the bill that failed last night was based on expenditures and revenue projections that were very much implausible for in the coming years. So again, they're going to try to implement these perhaps at a reduced amount, but I think most people in the market will be aware that over a 5-year period that a $500 billion cut in the budget or anything actually remotely like that is very unlikely to be achievable.
The Federal Reserve Board had promised to reward agreement on budget reductions with a cut in interest rates. Now any easing in its monetary stance is a distant prospect, and that makes the possibility of recession in the US economy that much greater.
It's always the alternative of a recession now or something even worse later. If, for instance, we allow a bill to get passed right now, which will avoid a recession, but will increase the deficit burden over the coming years, then by the mid-90s, the U.S. economy will be in real trouble indeed.
The repercussions for markets around the world are difficult to contemplate. Much of this week's rally had been based on optimism that agreement would be reached. Now, the disarray in the American administration has pulled the rug out from under traders' feet. Whether confidence has evaporated altogether, only the next few hours will tell.
And with Wall Street due to open in less than 2 hours' time, New York traders are preparing themselves for what could be their busiest day since last year's mini-crash. US securities houses here in London are busy giving their head offices any clues they can as to how the market is likely to open. Dealers at Dean Witter are making a bleak forecast. They expect the Dow to open as much as 30 points lower.
Well, the original thought this morning was that the market would open down 70. That moved to down 50. Right now, the thought about the New York opening is probably down 30 or so.
The market seems to be having second thoughts about this budget disagreement. Why is that?
Well, basically, I think it's a misunderstanding of the budget process itself. Yesterday was the vote on the resolution. In other words, the sense of the House of Representatives, and the sense was quite clear. We don't like this. I think one thing that's been forgotten and is not unimportant is that Monday is a holiday in the United States. So with all the Sturm und Drang, the government will not have to reopen until Tuesday. So what they've done, in effect, they only saw the proposals on Monday. They had 3-4 days to think about it, and they turned them down. Now they've given themselves 4 days to come up with a compromise, and we're pretty confident that that's what they'll do.
Can the markets be sure that Congress will actually bite the bullet?
The markets can never be sure about anything, but I think you'll find that that the reaction will be, according to expectations here this morning, somewhat muted. More muted. This is not a catastrophic event.
From past experience, any large falls on Wall Street will be reflected here in London. The market's already lower ahead of New York's open. At the moment, the FTSE's down 31.3 at 2039.1. Well, I'm joined by John Reynolds at County NatWest. So, John, first of all, what's the thinking been in the market this morning?
Well, as we'd heard earlier, one of the key factors behind the supports in the market this week had been the hope that the budget package would go through in the US, and that could spark lower interest rates there. So there's been a mild amount of disappointment, worries that Wall Street itself may open 30, 40, 50 points down, and that's led to a slightly nervous start today.
If Wall Street does open sharply lower and continues down that way, is it a foregone conclusion that London will follow suit?
Well, I think the fact that we're actually 30 points down now reflects the fact that we've largely discounted Wall Street opening fairly weak. We could see some further weakness if the fall is of the 50, 60 point magnitude. But I think overall the UK market should be able to hold these type of levels.
Looking at the question of whether there will be a budget-cutting deal, does the market expect an agreement to be reached?
Yes, I think it does overall. As we heard earlier, what we've really seen now is the first phase. We still have a few more days to go before we actually get into bigger talk of Graham-Rudman deficit reductions coming in and talk of much bigger cuts coming through. But I think we will see some compromise emerging over the next few days, but it's clearly going to be a nervous time.
And if there's no agreement, what then for the market?
Well, the big worry then is that Graham-Rudman targets are then brought into action, and we could be seeing much bigger cuts injected, perhaps as much as 100 billion over the next year. And the worry would be that that could force the US economy into recession, much deeper recession than many people are predicting, which would definitely have quite negative effects for the US economy.
John, thank you very much. Creditors of the troubled international trading company Peck are currently locked in negotiation in the city at a meeting which could well determine whether the company survives. Azul Nadir and his fellow directors are discussing Peck's liquidity problem with bank creditors at the Chartered Insurance Institute. Added pressure on this morning's meeting comes from the disclosure that the Bank of England drafted a letter last week asking the Turkish government to provide a cash injection of £100 million to save Peck from facing administration. Joanne Hart reports.
Today's meeting is not confined to Peck's bankers. Up to 300 people are scheduled to contribute their say, including accountants, lawyers and various advisors to the international trading group. Security is tight, and a pair of bodyguards were the first to arrive at the insurance hall. Then Peck minions appeared, carrying huge bundles of company reports and accounts. Droves of bankers and professionals soon began to show up, ready to hear what the Peck board has to say for itself. Azul Nadir, Peck's chairman, will first of all ask the banks to roll over £117 million of short-term debt and allow the company a 90-day standstill on debt repayments. In return, the company will undertake to dispose of a number of assets and float off part of its food division Del Monte on the US stock market. Going into the meeting, most of the bankers seemed convinced that it's more in their interest to support the company short-term than to let it go into liquidation. But they need to know once and for all whether Nadir has enlisted real financial backing from his Turkish allies. They may also demand that Nadir resign as chairman of Peck once the immediate crisis is past.
Our
hours have passed since today's meeting first began, and there seems little sign of an early outcome. Peck has now presented its case to an apparently sympathetic audience. Back in the city, though, the mood is far from settled, as rumours about Peck's future grow increasingly grim.
Joanne Hart, and now a quick check on the pound and stock market here in London. The FTSE down a little bit further, down 32 points at 2038.4. The pound up by 0.79 of a pfennig against the Deutschmark at 294.33. Now some of the other items of business news this morning. First, a look at what's happening to UK companies. The engineering group TI says acquisition talks with the American high-tech company EG&G have been terminated, with both parties unable to agree a definitive contract. TI agreed in August to buy the Fluid Components Technology Group from the American company for £128 million. Western Group has announced the closure of its Milton Keynes plant with the loss of 212 jobs. This follows a manufacturing review in the light of changes in defence procurement. And debt-laden Brent Walker has announced that by mutual agreement, Panmure Gordon is no longer joint broker to the group. Smith Newcourt continues as lead broker. Shares on the move this morning. Grand Metropolitan, the drinks, food and leisure group, is down 12 pence as it awaits the Monopolies and Mergers Committee ruling on its pub for brewery swap with Elders. The brewing group Bass has dropped 12 pence after yesterday's announcement of its Holiday Inn expansion plans. And Tranwood, the financial services group, has dropped 4 pence to just 3/4 of a penny after the failure of talks with a potential bidder. On the gilts market, the shorts are up 1/8 and the longs are up 3/16. Some of the key items of European business news this Friday lunchtime. The first statistics from a unified Germany show the August current account surplus has halved year on year to 3.4%. The Federal Statistics Office says the drop is due to an increase in imports and a drop in exports. Provisional figures for West German industrial orders have risen 4.8% compared with 3.2% in July. Domestic demand has been buoyed by large orders in the electronic industry and booming demand for cars. And Czechoslovakia has raised petrol prices by more than 30% in the face of oil shortages due to the Gulf crisis. The move follows recent severe cutbacks in Soviet oil supplies on which the country depends heavily. Isosceles, the company created in Britain's largest ever leverage buyout, has reported its first set of annual figures this morning. Isosceles was formed to take over the Gateway chain of food stores, which it finally bought last summer, paying a total of £2.1 billion. All but £200 million of the purchase price was borrowed from a number of banks, and that's left Isosceles with a substantial debt burden. So, in the 13 months to May, operating profits of £113.8 million were overwhelmed by interest payments of £147 million, making an overall loss of £33.2 million. But recently the situation has improved slightly. In the first quarter of this year, operating profits of £44.3 million were used to pay interest charges of £41.5 million, leaving a pre-tax profit of £2.8 million. Well, earlier this morning, Dermot Murnaghan asked David Smith whether the company was having difficulty keeping its head above water.
No, I don't think we're having trouble keeping our head above water, but clearly we would like to see the interest bill reduced. We have to say, of course, that much of our debt is swapped and capped, and our effective rate of interest is somewhat below market rates at the present time. But like everybody else, we would like to see lower interest rates.
Are you likely, though, to be in breach of agreements you made with the banks at the time of the buyout, particularly on interest charges?
I think ultimately we're likely to breach an interest rate covenant with our banks, but it's important to recognise why that is. That's going to happen because we have a bigger and more profitable business than we originally intended. So it's an issue that we've got to address, but it's a more pleasant one than some of the other retailers are facing at the present time.
So what you're saying is your sale of assets is going more slowly than you expected. Is that because you overvalued them at the time of the buyout?
No, I don't think we overvalued them, but the value that we put in the earnings stream from these assets is beyond the reach of people in the marketplace today. So we're very happy to keep the assets and to keep the cash flow from the assets. It does have implications for our funding structure.
Can we expect any news on the sale of Herman's in the United States soon?
I shouldn't think so. We're very happy with Herman's, and as we'll be showing today, there has been a dramatic turnaround in the first quarter of this year in the results of Herman's. So we're happy that at the present time we're improving the business quite significantly, and at the right time we'll sell it for the right price.
Have you put through a deal now with your creditors to take the pressure off
We have no deal of any kind with creditors other than a normal trading arrangement, and all of our suppliers are very happy to continue trading with us.
What kind of levels would you and your creditors of debt like to see in, say, 12 months' time?
I'm sure that our various lenders, and particularly senior debt lenders, would like to see our debt at a level, or our interest cover at a level, that makes them comfortable. And making them comfortable means that they can syndicate the debt, largely. But there are other issues in the banking world other than Isosceles at the present time.
David Smith, chairman of Isosceles. The FT 100 share index down 32.1 at 2038.3. So, Carol, obviously Polly Peck is dominating sentiment a lot at the moment, but it could have implications for other companies.
Yes, indeed, and certainly lots of people in the market are trying to second-guess which stocks are likely to be affected. We've seen one or two quite joker reactions today with that meeting still going on. They can't really do anything with the company itself yet, so it's one of the main talking points. And Standard Chartered has come under an awful lot of pressure today. The shares have been marked down quite heavily, as it's come to light that they are in fact quite a large lender, not necessarily the largest, but certainly one of the big ones. They'd thought to have about £50 million out in short-term loans to Polly Peck, and that's the reason their shares have been savaged. Second to that, people are saying with sort of gloomy forecasts about the likely fate of Polly Peck as this discussions continue and drag on and on. People are looking at other companies which have large debt liabilities and so forth, and the tide seems to be turning against them. And Maxwell Communications has come under a bit of pressure this morning. People are looking at their debt levels, and BZW's put out a sell circular.
Most of the top shares are down, and Reuters one of the biggest fallers this morning.
That's right, a long way the biggest faller today, and it's something of a bellwether stock. It always seems to sort of, if the market's down, then it falls further than the market, and vice versa when the market goes up. We also saw yesterday a downgrading from Cazenove, although they won't say exactly by how much. And today we've had a couple of further downgradings by Smith Newcourt and Kleinwort Benson. So it looks fairly gloomy. They're really, I think, affected by the change in sentiment towards American stocks today, and also, of course, the general economic climate.
And even food retailers not exempt, as they're a weak spot.
That's right. Well, they've issued a £70 million convertible Eurobond issue. And that really means that people are switching out of the ordinary stock and into the convertible, and therefore we've seen a drop in the share price.
Carol, thanks very much. Time for the break now. Coming up, on the first anniversary of 15% base rates, what's the outlook for mortgage rates? And why city gents are limbering up with the green goddess. That's all in a couple of minutes, so join us then.
Yeah, well, something like that.
Well, how would you like to do me a favour in return?
What are you saying there's strings attached to this job?
Well, no.
According to
The new Ford Escort breaks the law of averages.
Bush, a bin, a brick, a bus, a skip, a block, a crane, a truck, a queue, a rush, a push, a bump, a crowd, a tramp, a clamp, a crash, a bang, a jam. A cloud, a tree, a field, cow, a flower, a horse, a bike, a kite, a game, a shop,
welcome back. This week is the first anniversary of 15% base rates in Britain. But for the millions of mortgage holders, there's nothing to celebrate. As speculation rises over when the Chancellor will finally give in to a cut, building societies are considering what action they will take if and when base rates do come down. Damien Green reports.
1990 has been a miserable year for homeowners, with the prospect of a cut in the mortgage rate apparently receding indefinitely. But the expectation has always been that base rates would start coming down before the end of the year. And for many borrowers from Britain's biggest building society, the Halifax, this is especially vital, since the prospect of rates at their current level would have serious repercussions.
Mortgage rates themselves will stay where they are, but the actual charges, what people actually pay every month, will tend to rise. The reason for this is that a lot of people are on annual resets, particularly the Halifax. 2 million borrowers, probably over 3 million voters have a mortgage in Halifax. Now their current rate is nearly 1% lower in terms of payments than the Halifax mortgage rate. So unless we get a cut in mortgage rates by February the 1st from the Halifax, then from April next year, all those people will face an increase in their mortgage payment of about 1 percentage point in interest rate terms.
The 5 biggest mortgage lenders say that to allow a 2% cut in mortgage rates, base rates would, for the Halifax, have to fall 2%, for the Abbey National 2.5%, for Nationwide Anglia 2%, for the Woolwich 2.5%, and the Alliance and Leicester 3%. The question then remains, how fast would mortgage rates follow base rates down?
They won't automatically follow, but I think it'll be a very short interval before mortgage rates move in response to a base rate reduction, which after all will be indicating a generally lower level of interest rates. The reason for that is that the cost of wholesale funds will clearly fall in line with the base rate reduction, so that there will be very strong competition in the mortgage market, both from wholesale lenders and from the banks, who are substantially funded from wholesale sources. So yes, I think there will be an early reduction in mortgage rates once base rates fall.
What will happen to the mortgage rate if base rates don't fall? Might it actually have to go up further?
I doubt it. Clearly, the mortgage market is very difficult at the moment, both in terms of the difficulties that individual borrowers are suffering from, and we're very conscious of that, and also that there isn't a great deal of business about. So clearly there is a need for us to keep our pricing as keen as we can. So even if base rates don't fall, I think we'll try and keep the mortgage rate where it is, and certainly not higher, for as long as possible.
The gloomiest scenario for the housing market is that the Gulf crisis forces interest rates up worldwide, and this means higher base rates to protect the pound. If that doesn't happen, at least 1991 will be more cheerful in the housing market than this year has been.
This Sunday, City Gents are joining with well-known stars of the stage and screen to walk the streets of London in a bid to raise money for children with cerebral palsy. The walk is organised by the charity SOS, and it's invited company chairmen to walk alongside the likes of Sebastian Coe and Dame Vera Lynn. But before they set off, the Green Goddess Diana Moran put a few of them through their paces, as Tim Bowler reports.
Many of the city's bosses may be more used to exercising their minds rather than exercising their bodies in an aerobics workout. But this Sunday the briefcases will be left at home, and the businessmen will join the Green Goddess and other TV celebrities in a sponsored walk around London's Square Mile. The aim is to raise £150,000 for a special school for children with cerebral palsy and their parents. Simon Hawkins is one of those involved in the project.
The children with cerebral palsy receive treatment along the lines of the conductive education principle, which was pioneered in Hungary, and SOS's involvement in that is to fund the school for parents, which encourages the parents to learn alongside the children the best way of using the therapy for the children's benefit, so that the parents can continue the programs in the homes, at the weekends and throughout their daily lives.
The walk takes in most of the city's landmarks. Starting at the Guildhall, the walkers will reach the halfway stage at the Mansion House. By St Paul's, they'll be in the home straight, ending at the Guildhall again. But why not choose somewhere a little more scenic?
City men have big hearts. Often people don't realise that. And so, to me, particularly, it is ideal that it's taking place in the Square Mile, and for a cause that is something that is very dear to our hearts.
But for some, the absence of hills may well prove a blessing, as their reaction to the warm-up showed.
I've always associated it with a girly kind of exercise to do. But having done it, I feel it's a lot more stressful than normal exercise I would do, running, rugby, football, squash, tennis, etc. In fact, I even feel like I've pulled a muscle whilst doing the exercise.
Bearing in mind that most of them are desk-bound most of the time, I would suggest that quite a number of them obviously do some sort of sport after work. They're pretty good shape. I think they've been looking after their figures in more ways than one.
The city's streets are normally deserted on Sundays, but this weekend, businessmen will be swapping their golf courses for the square mile as they stretch their muscles and lighten their wallets.
That report from Business Daily's answer to the Green Goddess, Tim Bowler. And now a quick roundup of the markets. In Tokyo, the Nikkei closed up more than 500 points, having fallen back sharply from much higher levels after that US budget vote. Continental stock markets have also been hit. In Frankfurt, the DAX index is down over 23 points. A reminder that Wall Street is expected to open down around 30 points in busy trading. The US long bond has been hit by the prospect of no early cut in US interest rates. It's down 17 ticks, yielding 8.84%. However, the December long gilt contract is up 4 ticks. The price of oil, a barrel of Brent crude for November delivery, is down 55 cents at $36.85 a barrel. And on the bullion market, gold is down $2.75. The main business headlines again. The collapse of America's budget pact has jolted financial markets around the world. Wall Street dealers are bracing themselves for sharp falls this afternoon. And Peck has been meeting with its bankers as fears grow about its future. And just time for a last look at the markets. The FTSE down at 33.8, going still lower at 2036.6. And if you want to know what it's going to be like on Monday, join Dermot Murnaghan at 6:20 then. Have a good weekend.